Good afternoon and welcome to the third session of our Money Lecture Series by the Institute of International Monetary Research in collaboration with the Vinson Centre at the University of Buckingham. This is a series on the evolution of central banks and their roles in financial crisis by two experts in the field, Professors Charles Goodhart and Forrest Capie, both members of the Institute's Academic Advisory Council. I'm Dr. Juan Castañeda, Director of the Institute, and today we'll be hosting Professor Forrest Capie. Forrest Capie is Professor Emeritus of Economic History at the Caspian School, City University in London. After a doctorate at the London School of Economics and a teaching fellowship there, he taught at the University of Warwick and the University of Leeds. He was a British Academic Fellow at the National Bureau in New York and a visiting professor at the University of Aix-Marseille and at the LSE, and a visiting scholar at the IMF. He was head of the Department of Banking and Finance at City University from 1989-1992, editor of the Economic History Review 1993 to 1999, a member of the Academic Advisory Council of the IEA in London, and an advisor to the Shadow Chancellor of the Exchequer. He has written widely on money, banking, trade, and commercial policy, and recently completed the Commission History of the Bank of England by Cambridge University Press in 2010. His latest book, Money Over Two Centuries, was published by Oxford University Press in 2012. He has been advisor to the UK's Parliamentary Commission on Banking following the global financial crisis. Professor Capie will discuss today the roles of central banks in great financial crisis, after which we'll allow time for Q&A with viewers at home. Today we'll be covering the pre-20th century period, followed by a second session by Professor Capie next week on the 20th and 21st century crisis. Today's presentation will be recorded and made available on our YouTube channel. You can go to our website to access this presentation and other webinars in our series. Questions must be submitted via the chat option on Teams, and I will moderate them and address them to the speaker. Forrest, we're very grateful for your collaboration with the Institute. You're a good friend of ours. You always support what we do, our events, our research, and we are honored to have you here. So the floor is entirely yours. Thank you.
In attempting to answer this question, what should central banks do in a great financial crisis? Naturally, I turn, as an economic historian, I turn to history. How did a central bank come to deal with large financial crises? And if they proved successful at that, does that mean that we now know what to do? Now, I've always been a bit uneasy about lessons of history. I'm often impressed, but sometimes alarmed at the speed with which some people can spot lessons in history. But then you might say, well, if there are no lessons, what is the point? Well, there are answers to that. And I think part of the answer, one answer at least, is history should breed caution. And even more than caution, sometimes as far as skepticism, shall we say. That said, I think there are lessons to learn, particularly about financial crises and the Bank of England's behaviour and experience in the 19th century. Very briefly, through a series of crises, some outside pressure and some new personnel, the bank learned how to deal with and even prevent crises. The banking system, of course, must be well behaved and should be allowed to fail if it's not behaved. And the Bank of England should accept its role as the lender of last resort, even if we still don't really have complete agreement on how that should be carried out. In addition, all of this previous experience in the 19th century took place when deregulation was taking place. Deregulation generally and deregulation in banking. So there's a need to keep in mind the regulatory system. But can I have slide 2 up, please? That is really just what I have said. So that's the territory that I'll be covering. And we move on to financial crises. First of all, then, what is a financial crisis? There have been many approaches to the question. For example, Richard Grossman gauges it in one of three ways. First, it's a high proportion of banks failing. Or second, if there is a failure of a very large bank. And thirdly, if either of these two is prevented by state assistance. Reinhardt and Rogoff, covering centuries of financial turmoil in a relatively recent book, say that it is a bank run leading to state takeover or the closure of important financial institutions. Another view, that of Charles Calomiris, is that it is where the aggregate net worth of failed banks is greater than 1% of GDP. To John Turner, it's the failure of commercial banks, but particularly captured in the failure rate, the number of banks that are failing and as against the total, and also in the capital of the failed banks related to the total bank capital. And these, in his view, can be supplemented. Now, there are different kinds of problems in all of these that lead me to prefer the approach of Anna Schwartz, who defined a real financial crisis, as opposed to a pseudo-crisis, as a threat to the payment system. It's essentially a banking crisis. And she wrote, a financial crisis is fueled by fears that the means of payment will be unavailable at any price, and in a fractional reserve banking system leads to a scramble for high-powered money. Now note the fractional reserve banking system. In the earliest banks, say those of the pre-18th century, there was little, if any, fractional reserve use. What was essentially a cloakroom, there can't be a crisis. If customers take the deposits, place them with a holder, and the holder keeps them safe, there is no risk of a financial crisis. But when the holder begins to lend out the deposits, then the risk begins to appear. But the risk will not be high if the lending is little. And so the very early, indeed across the 18th century, what I'll call the banking multiplier was very low, perhaps just over 1, maybe up to 1.5, well, 1.2 or 3 by the end of the century. So there's not much risk of a financial crisis there. But in the 19th century, that multiplier had risen to between 3 and 4. And so the possibility, the real risk, begins to rise. Now, the main crises in the 19th century were those of 1825, 36 to 39, 1847, 1857, and 1866. And I'll come back to talk about these briefly. But let me just go back now to Kindleberger, because Charles Kindleberger set out some time ago the pattern events that generally led to such a crisis. And the crises were all remarkably similar. To begin with, there was some displacement, that is to say, some new opportunity that opened up. A new market, perhaps, a technological breakthrough, perhaps a process change, something of the kind. Investment was then made, and before long enthusiasm developed, more funds became available. There followed switching to invest, and a boom develops. And that is followed by borrowing to invest. And at this point, the banking system gets involved and more borrowing takes place. Euphoria gathers pace and others join in. But at some point, insiders begin to get nervous and some pull out with their profits. Fears then spread and lead to others leaving and then on to panic. But bank loans can't be repaid from the sale of collapsed assets, and the banking system is at risk. There's a rush for liquidity, the ultimate source of which is the central bank. So the essence in each of these crises was remarkably similar. Easy money, asset price boom, monetary tightening, panic and crash. And so this is where the central bank comes in. But let's say what it is, first of all. There are many views and certainly several possible acceptable definitions. But the key role is that of the lender of last resort. One of the Bank of England's former historians, Richard Sayers, said the essence of central banking was the lender of last resort. Because of the bank's central position as banker to the banks at the center of the financial system, it is in the unique position of producing and supplying liquidity when the markets require it. In other words, to act as a lender of last resort. But how can the ideal operation of this be achieved? There continues to be disagreement on the question, but I think the following is a good to best interpretation of the leading contributors to the debate. The lender of last resort supplies funds to the market in times of need. It does not supply individual institutions. In its proper form, it should not engage in bailing out firms of any kind, be they banks or non-banks. Therefore, if the operation could be carried out where the identity of those seeking funds was not known to the bank, that would be ideal. Banks holding good quality assets will have no difficulty in getting hold of the funds they need. Banks with poor quality assets are likely to suffer. And in times of panic, the interest rate would rise. Now, by something of a happy accident, this was in effect the system that developed in England. At the beginning of the century, the Bank of England's joint stock monopoly offended the other banks. And such was the antipathy that when the new joint stock banks were formed after the crisis of 25, the others were restricted to being small partnerships, they preferred to keep a distance from the Bank of England. Discount brokers therefore emerged and transacted the business between the commercial banks and the Bank of England. And these discount brokers gradually acquired a capital base and developed into their later form of the discount house. So the mechanism was that when the commercial banks were under pressure in a liquidity squeeze, their first line of defense was to call in the loans they had made to the discount houses. This in turn sent the discount houses off to the Bank of England, where they would cash in some of the assets that they were holding, just bills in the main. In this way, the central bank never needed to know where the great bulk of the demand was coming from. The precise source of the demand is largely an irrelevance. Good bills get discounted. And the bank had learned to trust the quality of the discount houses' bills. All right, so having said what constitutes a financial crisis and said what a central bank is and does, it's straightforward matter to say what they should do in such a crisis, and that is they should resolve it. It falls to them. They have the responsibility, they have the ability, and they have the wherewithal to do it. That said, of course, it's seldom quite that straightforward. Bernanke was chairman of the Fed in 2007-8. He was a student of the financial crises of the Great Depression of the 30s, and he had absorbed the great lesson of Friedman and Schwartz on the role of the Fed. But the book by Bernanke, Geithner and Paulson reveals a more difficult story. Bernanke was chairman of the Fed. Geithner was New York Fed president and later Secretary of the Treasury under Obama, and Paulson was Secretary of the Treasury under Bush. And their jointly authored book on 2007-9, The Financial Crisis and Its Lessons, make clear just how difficult it was at the time to discern what the nature of the problem was, and therefore how it might be tackled. What exactly was going on? What were the toxic assets? Where were they? How big a problem was it? What was the best way of tackling it? What exactly needed to be done and when? Restoring confidence became key, but how was that to be done? They combined and took certain actions with that ambition, only to find that it had the opposite effect than they had intended. I happened to have just finished reading the Ukrainian Sergei Prokhy's book, Chernobyl, before I read the Bernanke et al. Book. And what struck me were the strong similarities in the handling of the two crises. In Chernobyl, what was the nature of the problem? There was a fire, but where exactly? It couldn't be, they said, the reactor, because that was Soviet built. But with the dawning realization and acceptance that it was the reactor, how could the fire be put out? And if not put out, how could it be contained? At a certain point, water was the worst thing that could be introduced. And so it went on. Meanwhile, the risk of something bigger happening, an explosion that would blow away much of Europe, remained a possibility. So the question that we have to keep in mind is what is the nature of the information that is available to the policymaker, sorry. Let me turn then to say something about, and this will only be briefly, about the crises of the 19th century and how the Bank of England responded to them and gradually found its way to an understanding of what it had to do to resolve the crisis and then ideally prevent them from appearing in the first instance. In 1825, there was the first great financial crisis of capitalism. It had all the features of what would become a typical crisis of the kind set out by Kindleberger. Its origins lay in new opportunities, monetary expansion, a boom, followed by fear and panic. In the lead up to 1825, there had been easy money, abundant credit, lending on a grand scale, both domestically and internationally, a stock market boom, and so on. And then there was some hesitation in the summer of 1825, and it all came to a halt at the end of 1825 with bank failures and widespread distress. Incidentally, it's not always clear what the trigger in these cases is. Now, at the beginning of the 18th century, there had been several contributors to a developing literature on the changing financial and monetary environment. And many of these addressed the question of the central institutions. We can move to the next slide, please. That's it. So there were several contributors to how the world was changing, particularly the financial and monetary world. And many of these addressed the question of the central institution in the system and indeed the role of the lender of last resort. Francis Baring was possibly the first person to use the term, but a man called Henry Thornton gave a fuller and even a comprehensive treatment. He described how the Bank of England should behave in normal times, as he said, letting the money supply vibrate only within certain limits. But he said, in times of liquidity squeeze, the bank should relieve the pressure. He went on to say it shouldn't be doing this anytime they spotted some sort of pressure, because that could lead to country banks, the commercial banks, bringing disaster upon themselves. The bank stepping in might encourage, as he said, their improvidence. So there was a risk of moral hazard. There were others contributing at the same time to the debate. Thomas Joplin, for example, in 1825, set out how the bank should behave. He said they should increase the note issue to offset the loss of circulation. And Bagehot, writing in the 1840s, not yet Lombard Street of 1873, but writing in the 1840s, brought even greater clarity. He said, it's a great defect of a purely metallic circulation that the quantity of it cannot be readily suited to any sudden demand. A paper money can be supplied in unlimited quantities, however sudden the demand may be. And it does not appear to us that there is any problem, any objection in principle of sudden issues of paper money to meet sudden and large extensions of demand. But the Bank of England was not ready quite for this advice. It learned its role extremely slowly. It resisted the advocacy of these theorists and commentators. Now, the lender of last resort is the ultimate source of cash in the system, and it's usually the central bank. It should provide liquidity to the market as a whole and not bail out individual firms, banks or non-banks. It's the knowledge in the markets that the supply cannot run out that serves to assure the market and allay the panic. In its ideal form, it should do this anonymously. There should be no commercial rivalry that might deflect the bank from its task or involve it in a conflict of interest. And if this is all known in advance, then the bank, that is how the bank will behave. That is what we would call pre-commitment now. Then the picture is pretty much complete. Now, a commercial bank might from time to time extend loans to customers who are illiquid or insolvent. And they may even do that when there is a risk of them losing out completely, if they gauge that the lending was in their own wider interests and for their own reputation and for their commitment. In the same way, a central bank in the making may well rescue one of its client or correspondent banks, just as the commercial bank did for its customers. But we wouldn't want to describe that as a lender of last resort. Once it comes, as it were, to maturity, then the bank can step back and attend only to the liquidity needs of the market as a whole. So no central bank would want to pre-commit itself to giving special support to any individual bank that was running into liquidity problems. A bank liquidity problem that is not caused by some technical problem is likely itself to be a reflection of some deeper suspicion about solvency. Consequently, an unqualified pre-commitment to provide assistance to an individual firm would involve too much moral hazard. In any case, it's worth considering what could reasonably be meant by bailout. Central banks in general do not have the capital resources to salvage single-handedly an institution of any significant size, significant that is, in the sense that it could be damaging for the rest of the system. If the central bank discounted at face value the inferior assets of an individual institution, then these assets were subsequently marked to market. Their values would appear much lower on the bank's balance sheet. The bank would therefore be damaging its own balance sheet since it's parted with cash for lower value assets. If that in turn requires government assistance, then the bank is straying into fiscal action, which is surely unacceptable. We can move to the next slide, please. What happened in 1825 was a shock to the system, and the bank, in the end, found a way of resolving it without accepting that it would behave in that way again. But it did quell the panic, and in a way it had taken its first steps on the road to being a lender of last resort. And over the next several decades, after 1825, there were regular financial crises of precisely the same kind, not quite as severe perhaps, but of the same kind. In the 1830s, for instance, the bank had received especially large deposits from people like the East India Company and so on, and went out of its way to find employment for the funds. An increasingly adventurous spirit was abroad, and as a pamphlet of the time put it, there was a loss of sight of caution and common rules. A boom, monetary tightening, and a crash. In the 1840s, there was a similar experience. Liquidity was plentiful. The bank had cut its discount rate to 2.5%, and railway investment had turned into railway mania. The boom came to an abrupt end at the end of 1847, with all the same troubles, bank failures and their consequences. In the 1850s, it was feverish speculation in gold discoveries on the West, in the American West. The bank followed market rates down, and when bad news began to filter through from the American West, bank rate went up and panic followed. But when the banks were seen to be in trouble, the bank was slowly appreciating the centrality of its role and the tools it had in order to combat crises. And once again, it began to lend more freely than it normally did. And then came 1866. In 1866, there was, I think we can move on to, yes, we're there. Yes, we're there. 1866. So in 1866, there was the biggest crisis since 1825. And the crisis, of course, has taken the name of the institution that was at its centre, Overend, Gurney and Company. Overend was a huge financial institution, possibly the largest in the world, and had come to rival the Bank of England itself. But it had moved from being a partnership in the early 1860s. It had taken advantage of the newly allowed limited liability. It had then expanded its activities greatly, and in the course of the mid-Victorian boom that was underway, it was lending on enterprises it had previously stayed well away from. It got into difficulties and it appealed to the bank for help. Because of its recent behaviour, no help was forthcoming. It failed in May 1866, and the ensuing panic was the worst since 1825. It's worth pausing here to consider the too big to fail doctrine, as it might have applied to Overend Gurney. Overend had become banker to the London and country banks, and on the day it failed, the Times said it could rightly claim to be the greatest instrument of credit in the United Kingdom. Its balance sheet was roughly 10 times the size of the Midland Bank and the Westminster Bank, and they were two of the biggest commercial banks in the country. And while they operated with capital asset ratios of about 9 to 11%, Overend capital asset ratio was 2%. It's true that discount houses had lower ratios, but Overend had moved into banking business. Overend's appeal to the bank for help was refused, since the governor took the view that the bank could not assist one concern unless it was prepared to assist the many others which were known to be in a similar plight. But neither did it have the capital resources to recapitalize such an institution. And in any case, there was considerable animosity between the two institutions. Nevertheless, the refusal to help Overend can clearly be seen as a further step on the road by which the bank came to see its function as coming to the aid of the market as a whole, rather than bailing out imprudent and insolvent institutions. If Overend could be let go, then any bank was at risk, and banks became more careful in the aftermath of the crisis. Well, the panic of 1866 was huge, and in spite of Overend's size and apparent centrality to the system, the bank once again, if a little too slowly for Walter Bagehot's liking, lent extensively to the market. Of course, many banks were affected by Overend's failure through little fault of their own, and the bank responded, as it had now learned to do, by supplying liquidity to the market in sufficient quantity to allay the panic. The panic passed, and the banking system went on to become strong and stable. The bank's refusal to aid Overend can be regarded as a signal that even the largest would fall in the absence of prudent behaviour. Well-behaved banks would be able to obtain the liquidity they required when the panic appeared. This was an important step on the road towards a sound policy towards financial crises in the Schwartz sense of the term. After 1866, there was over 100 years of financial stability in England. There were no financial crises. Banks still failed. There were failures every year. But any threat to the payment system was avoided by a combination of good behaviour on the part of the banks and the readiness of the Bank of England to act as a lender of last resort, and the knowledge in the markets that it would so behave, lending to the market as a whole and not bailing out poorly behaved firms. Now, I said there were no financial crises after 1866 for 100 years, and some will no doubt have episodes in mind that are sometimes considered, described as crises, but that I would say are better described otherwise. So in 1878, in 1890, in 1914, and in 1931, there are dates that are frequently debated. In the first two, important individual institutions failed. In 1878, the City of Glasgow Bank. In 1890, Barings. In 1914, there were extremely unusual circumstances on the outbreak of war. And in 1931, there was an exchange rate crisis. Now, apart from 1914, in none of them was the payment system at risk. And so there was no need for the bank to do anything out of the ordinary. It so happened that it came in and organised the rescue of Barings and so on, but that was not a lender of last resort activity. It might be described as crisis management, perhaps. Now, I'll say something very briefly about 1914 in a moment, but what I would like to do now is by way of summing up and saying, what have we learned? And we might move to the next slide, please. In the course of the 19th century, the commercial banks learned prudence. They learned the appropriate cash, liquidity, and capital ratios to hold, and to whom to lend and on what terms. The central bank learned how to behave as a lender of last resort. And a discount market had evolved that helped to facilitate that operation. But there was another element in the story, and that was the role of government and regulation. The striking thing about all this to the modern eye is that what has been described was all done in a period of laissez-faire, and banking followed that course. The period preceding that ran through the 18th century and before, was that of mercantilism, the supremacy of the state. And in that century, the 18th, banking in England was severely circumscribed. But the reaction to the inefficiency and corruption in government that mercantilism produced was such that at the beginning of the 19th century, the desire was to seek small government, free trade, and sound money. And so in the new climate of laissez-faire, roughly from the 1820s onwards, after each financial crisis, the authorities deregulated. When regulation began to return in the 20th century, the opposite was the reaction. More regulation was imposed. But in the 19th century, after a crisis, the immediate response was to find a way of easing things in the system. And so the first stage of this process came with the relaxation of the usury laws, at least for the Bank of England. The laws had been in force for centuries. In 1825, when the crisis blew up, the bank did lend, but it would not lend at a rate above 5%, it could not lend at a rate above 5%, which in the context of the times was hardly high enough. After the crisis, the usury laws were relaxed, and at the next crisis, the bank did raise its rate above 5%. At the same time, the restrictions that had been in place throughout the 18th century on banks being limited to partnerships of only 6, that was clearly outdated and had to go, and joint stock banks were allowed to form. Initially, they could only operate outside London, but after a few years, in the 1830s, they were allowed to operate within London. The gold standard, which had been rather strictly defined in 1844, and in a way that proved too restrictive when the 1847 crisis developed, so it was clear that the bank could not hold to the law and deal with the financial crisis in the way that it had learned to do. And the resolution was for the Chancellor to agree with the governor of the bank that they could, in effect, ignore the Act of 1844 and so allow them to print all the liquidity that was needed. There was also a growing discussion on the merits and demerits of limited liability from as early as the second quarter of the 19th century. And after the crisis of 1857, these laws were relaxed and limited liability was available for those who chose to take it up. Not all did by any means, but it was an option. And so there was a relaxation in the rules on governance. And at that point, banking was extremely lightly regulated. And everything was then in place that will allow the bank to act as a lender of last resort. Generally speaking, it did so, though on occasions it might have blurred the issue. Nevertheless, there followed this very long period, really from after 1866 until we get to the 1970s, when there were no financial crises and financial stability was really taken for granted. Now, to finish off the period, I'll say something very briefly about 1914, because it's frequently cited as a financial crisis. In 1914, there was a major problem in the financial system on the outbreak of war. There were, though, none of the common features in the build-up to a crisis. So there was no monetary ease, in the few years before. There was no developing boom. There was no excitement. Nothing new had been identified. And there was no fear of anything untoward happening. There were simply the seriously disruptive problems produced by the failure of remittance from continental Europe. The solution was, in some respects, similar to that for normal crisis, but there also had to be imaginative, supplementary resolution. There was an injection of liquidity required, and that was provided. But there were also guarantees given to the accepting houses and the discount houses on their bills. The liquidity injection happened to coincide with the abandonment of the gold standard for the reasons of war, and there were failures in not retracting that liquidity. But while 1914 is a good guide as to how to deal with imminent systemic collapse, it's not a useful illustration of a typical financial crisis. Well, that takes me to the end of the long 19th century. In the next lecture, I'll turn to the 20th and take us into the 21st with the two biggest crises of their time, that of 1929 to 32-3 and that of 2007 to 08-9. Others will get a mention, but these two were, of course, truly global and on a huge scale.
Thank you very much, Forrest. It's been a fascinating story and how different it is to what we have seen recently. But of course, this is something we're going to address in the next lecture.
Yes, I think there is precedent in the Scottish system, and it's worth remembering that Paget was rather opposed to the Bank of England, and he saw something closer to a free banking system where exactly that kind of response would have taken place. The commercial banks would have looked after each other. If they're confident of their other members of the club, as it were, their behavior, then there's no need to be frightened, and deposits can be moved around to wherever they're needed. So there is quite a strong argument, and I think there is quite a lot of evidence, though it has to be treated carefully, that commercial banks could indeed look after themselves and organize the appropriate assistance where that was needed. Yes, it's a slight contradiction to my saying that a lender of last resort of the kind of the central institution needs to step away from conflict with rivalry with other banks. But I think in the free market, in the free banking system, then of course profit seeking is the obvious necessary component of the system, but it's with a view to the long-term profits, or individual long-term profits, to keep the system balanced. That would be the incentive to provide help for a bank in need. Well, I'm not absolutely sure about that. I think Keynes once famously said that central banks liked financial crises because they made big profits. But in the case of England, really from the very earliest bit of the 19th century, the Treasury stepped in when it became obvious that the gold standard wouldn't be adhered to. The bank would have to print money. The Treasury insisted that all the profits from that excess issue would be returned to the Treasury. So even if we look at the Bank of England's profits across the 19th century, we do see not huge amounts, but little peaks at these crisis points, But if they were, if they came from the excess issue and the ability they were given to print extra notes, then these profits had to be returned to the Treasury. So there was no incentive, as it were, for the bank to make profits to keep them in these particular crises. No, I don't think they did. If the question's put bluntly like that. In fact, I'm inclined to say that in the course of the 19th century, government never became involved in the resolution of a crisis. And of course, that is different from we experienced in the recent past, but I'll come to talk about that on the 07-09 crisis, where government was involved at quite an early point. It seems to me that the bank being responsible for, the central bank being responsible for supervision is a rather obvious and necessary role. I know that all changed in the late 20th century, but because the bank in the 19th century was slowly acquiring this responsibility for financial stability, then it needed to be sure that banks knew how to behave, and it had a close interest. Of course, for a very long time throughout the 19th century, the bank was doing its own banking business with private customers. And while that was in decline, it nevertheless was in very close touch with the markets. And so it knew how the banks, commercial banks, all behaved, what kind of assets they were holding. And it was also very close, of course, to the accepting houses that developed and to the discount houses. And it could watch the quality of the bills, the kind of bills that were coming through over a very long period. And it would be alerted at early stages as to whether there were changes taking place, and it would make its views known discreetly around the market, that it was less happy with what was happening than it would like. And so that seems an obvious thing for the bank to be involved in the supervision and nudging direction for the commercial banking system. When that was changed in the late 20th century, they were all supposed to be in close touch with one another, but that kind of system, I think, seldom works smoothly. Yes, I think that is the case. And the famous case was in 1907, when the New York clearinghouse came to the rescue of the system. Whether it's ideal or not, I'm not sure, but I think it is an illustration of the fact that the commercial system can look after itself. Yes.
Thank you. There's a very brief question on the measurement of bank solvency. Which is the best measure of bank solvency?
I think that is impossible to come up with a measure. Banks themselves should have a fairly good appreciation of what their position is, but they're the ones who know what, or have the best idea of what the quality of their assets is. And so to come up with, say, capital asset ratios as an indicator of the strength of the bank depends critically on the quality of the assets. Outsiders are unlikely to be very good at assessing the quality of these assets. Banks themselves are better left to do that. And so I think that so long as the rules are clear, that banks will be able to get liquidity when they need it, and they will therefore not run into solvency problems from holding poor quality assets, then that's the best that we can expect of the system. Well, I think my answer is much the same. If there is a regulatory requirement on a capital asset ratio, some figure is 10%, say, and banks hold and advertise the fact that they hold 12 or 15 or whatever percent, it shouldn't imbue us with any confidence if we don't know what kind of assets they're holding. If these assets are very poor quality, then it doesn't much matter what the capital asset ratio is. Once the crunch comes, then the danger is that they won't be able to survive it.
Thank you, Forrest. So we have taken enough of your time. I very much appreciate again your generous offer today to deliver the first lecture, which is going to continue next week with the 20th century and the 21st century crisis. So I'm looking forward to it. And again, I thank you very much for your presentation today and for taking the time to answer to the questions as well.
Pleasure. Thank you.